All right, we're live, and those of you who are already in attendance, give us a minute or two. We allow everybody to get settled, get their lunch, coffee, or whatever, um, and get settled in. I think you're going to enjoy this today. Got a good group in here. Um, and hopefully it is not as hot where you are as it has been here in Philadelphia. It's been miserable. Um,
We want to talk about miserable, Joe. I came into Las Vegas here at 118 degrees. That's so that's where I am right now. Oh, yeah, but I'm gonna be at the site with Russ. Actually we're both here in Vegas. We're gonna be at the Owen site, this later on today, and we have the groundbreaking tomorrow morning.
oh goodness!
So
Oh my
it's
God!
pretty exciting from that point, but it is hot, you know. And I
Oh,
finally got to experience the dry heat, and I don't like it.
you don't like it?
I don't like it.
I always hear it's supposed to be better, but I'm not sure I buy that.
It felt like a sauna. I mean, I did a charity walk, with my wife. I went down a block and came back last night, and it felt like a sauna
Oh
the whole
God,
time. And
120. My gosh.
I was like, let's cut through this. Let's look at this hotel. Let's cut through here. Let's go to this casino.
Yeah, I've never go outside. I take that little tram, that
Oh, do you?
goes it cuts
Uh,
through all the anyway. But
it cuts
get
through
out there,
everything.
it cuts through everything. All right,
Exactly.
we'll get started then. Hopefully, everyone's that is attending is settled in. If you're not, don't worry. You're going to get the replay. So it'll come to your email box today or tomorrow. Um, I think Michael, our producer, will get it out the door before the week is out, so you can watch it over the weekend and then get in touch with these guys. The whole self storage area, we've covered it quite a bit. It's been a high performing asset class for 30 years, and the common refrain I hear now is that you need to have self storage as part of a diversified real estate portfolio. That I hear, it's a common refrain I hear in a lot of the investor meetings I go to. So those of you who have some in your portfolios already, may be asking, should I do more? And those of you who haven't, what's the state of play? This has been going on for 30 years. How long can it last? What does today's market look like? How does it differ from what I heard about 20, 30 years ago or 10 years ago? And then, can I still get in? And so we've got two Sherpas with us today who not only will bring us up to speed on the state of play, but they're also going to walk through a couple of thumbnail case studies of new projects. These are things that are actually happening now. So before I get started, before I introduce them and get started, I have a disclosure. It's the heretofores and notwithstandings. And the views expressed by Camel-Plan webinar speakers are those of the speakers and don't reflect those of Camel-Plan, its members and employees. Camel-Plan doesn't guarantee the accuracy or information provided by the speakers. Um, Camel-Plan, its members and employees do not accept the liability or responsibility for losses. Uh, in short, we encourage you, we do this at every step. Whenever I'm talking to someone on the phone, and that's a dozen times a day, is you seek out the expertise of your tax advisor, your CPA, legal counsel, because we are not tax advisors, CPAs, or legal counsels. So enough of that. Um, as I mentioned, we have two people with us today that are going to walk us through this. The first is Russ Colvin. He's CEO, President, Chief Investment Officer of Your Storage America. That's a national acquisition and development platform. Prior to that, prior to being with YSA, Russ was CEO and President of North American Storage Group, Chairman of StoreSmart, and Principal of Alton Storage. So you see he has quite a bit of experience in this area. He's also got quite a bit of experience in multifamily and commercial real estate markets. And you want to read his bio, and you want to read Billy's bio too, because he's very involved in community service, from youth groups and food banks to arms control think tanks, of all things, and law enforcement, where he has an extensive legal background. And he's the winner of the Jim Webb Award. Now, those of us who are a certain vintage know who Jim Webb is, and I thought that was pretty cool. So with Russ today is Billy Hayde. Billy's responsible for strategic direction at YSA. So he brings this extensive background in investment banking at the executive and board levels on Wall Street. You're going to want to check out this bio too, because it is extensive. He's been the lead at least a half a dozen investment banks, major funds. He's on the board or advisory board of multiple private and public companies. So I think today you're in really good hands. So without any further delay, Russ, I think you're on.
Okay. Good afternoon, and thank you to everybody for attending today. I realize how busy all of you are, and I certainly appreciate people carving out an hour or so to listen to our presentation. I hope you'll find it interesting. What I'd like to do today is start out with the industry and how the financial community views the industry and why it's been so successful, and then get into some projects, keeping in mind that everybody's on a tight schedule. Hope you'll find it interesting, and then at the end, I think we'll have a little Q&A. Okay, next slide. This is the disclaimer, obviously, something everybody should read carefully.
And we'll be providing copies of this, right?
Yes.
Yeah. Okay.
Yes.
Great. Because this
Next
speaks more
slide.
than the length of ours. Okay.
The self-storage industry, as I alluded to, has become one of the most successful commercial real estate asset classes in the United States. And as we will talk about today, it is essentially outperformed every other product type, while at the same time, and this is perhaps one of the most interesting things about self-storage, is that it's considered such a safe investment, yet it delivers returns that often, outpace other types of real estate that are considered very safe, like industrial or multifamily. We'll get into that. Anyway, next slide. REIT sector returns fundamentals. This is interesting. Next slide. For the past 30 years, self-storage has been the top performing asset class in the NAREIT Index, the National Association of Real Estate Investment Trusts, delivering average returns of 17.3%. So literally has outperformed every other product type on average for the last 30 years. Next slide. This is a bit more illustrative, shows you basically over on the right here in the green, you can see self-storage and how it's stacked up against the other product types. But as I mentioned, most people consider industrial and residential / multifamily to be very safe asset classes, and self-storage has outperformed all of them. Next slide. This is a example of the growth of self-storage REITs. Public Storage, the largest owner of self-storage in the world, about 3,000 self-storage properties. Market cap, most recent check, it was about 51 billion. You can see the growth of the value of the stock over the past 20 years. Company's been around since 1972, but is a very solid performer year in and year out in terms of delivering results to investors. Next slide. Extra Space, the number 2 self-storage company in the world in terms of the size of their portfolio. Market cap a little over 30 billion. And if you look at here, the growth of the value from 2008 to the present, it's pretty impressive in terms of the growth and value for the company. Next slide. Another story, CubeSmart, basically the number 3 largest self-storage REIT in the country. Same story in terms of the growth of value, market cap, presently around 10 billion. Next slide. NSA is a relatively new, came around in 2015. Market cap started out about 200 million. presently about 5 billion. And again, a solid performer. In fact, have sold a few properties to them. Next slide. This is an interesting slide. This shows the performance of various asset classes during the pandemic. And as we'll allude to in a few moments here, also the Great Recession. But if you have a real estate investment, you obviously want something that's going to perform well, whatever the economic conditions may be. And certainly the pandemic was a difficult time for a lot of real estate asset classes, commercial real estate asset classes. And so you see here that during the pandemic, self-storage outperformed everything by leaps and bounds. Very impressive. And again, outperforming industrial and residential as well. Next slide. This is something I like to show people, public storage, the top shareholders in public storage. So these 10 groups here, which I'm sure all of you are familiar with, have major positions in terms of stock ownership in public storage. So these groups own about half of the stock. And so you look here and you see Vanguard owns what, nearly $6 billion worth of public storage stock. BlackRock has about $4.5 billion, and you see the various positions. You've got everybody on here from Charles Schwab to JP Morgan to T. Rowe Price, Wellington, all household names, as you know, in the investment community. But what does that tell you? It tells you that the financial community views this asset class as something that is an excellent investment. It's a safe investment. And I don't need to tell anybody on this call that if Vanguard owns $6 billion worth of your stock, they must feel it's a pretty safe investment. Next slide. Once again, this is an illustration. This is Extra Space, very similar. These top 10 shareholders own about half of the stock, but some major positions. You know, again, you got Vanguard, you got BlackRock, Capital World, you know, where they have $1 trillion portfolio or something like that. But it shows you how they view this asset class. Next slide. CMBS data. The next graph is going to show you how self-storage loans performed before, during, and after the Great Recession. And again, just like I showed with the pandemic, it outperformed everybody else. Okay, next slide. So this is a historical delinquency graph for various asset classes. So you got multifamily on the left, retail, office, industrial, and then you have self-storage here. And this is an average of the delinquency rate on this asset class from second quarter of 2006 to 2015. And in particular, you look at some of the asset classes during the Great Recession, which was 2009, 2010, and it lingered beyond that. But self-storage had, you know, very low delinquency rates, while you look at some of the other asset classes here, even multifamily had pretty, you know, double-digit delinquency rates, while self-storage remained low. But on average, self-storage is 1.62% over this period, about 9 years, again, outperforming everything else. Next slide.
Just a note, if you have any questions, put them into the chat or our Q&A bar, depending upon what app you're using to watch this. I see Bruce has his hand raised. Bruce, if you've got a question, please put it in the chat box and we'll get to it. Thanks.
This slide was interesting. This was a press release that we uncovered just recently. This was from Fitch. Everybody's familiar with Fitch, and they monitor CMBS portfolios. And you see down here towards the bottom, they're talking about the delinquency rate for various asset classes. On the right was the period before, on the left is the current period. But you see these various asset classes, and they show the delinquency rate. And again, multifamily, industrial are pretty low. But then you have self-storage, delinquency rate, 0. I think this kind of speaks for itself. Next
Yeah.
slide.
Yeah, especially compared to the eviction processes
Yeah.
associated with other classes. So
One of the things that we feel is important in terms of developing self-storage is to make it a relatively foolproof process. And having done this for a long time and done projects all over the country, from California to Massachusetts to New Jersey to Texas and all over, basically, Missouri, it's important to have, you know, a absolute top-notch contractor, and then when the project is finished, to have the best possible third-party manager. Now, there are a number of different schools of thought on this subject, but in terms of third-party management, I'm a strong believer that the public REITs have the best third-party management platform. We certainly do the asset management, and we essentially manage the property manager, but in terms of the overall systems that they have in place and their capabilities in various marketplaces, we could literally do a presentation just on, you know, that subject in and of itself. So they have excellent reporting. They have, you know, great platforms in terms of search engine optimization, driving people to a site. And more than 80% of all your tenants in self-storage come from the internet. So having those types of platforms that each of the public REITs literally spend millions of dollars a year on is very valuable. So our strategy basically is we use the best contractor we think in the country in self-storage, which is Arco Murray. They're also the number 3 design build construction firm in the United States. They do well over $3 billion a year. So one of the largest as well. So this partnership, if you will, we work with the best contractor. We get the manager involved from the very beginning before we even break ground. So it's basically a team approach to developing these things. We're all working together. And then when the project is completed and rolls out, you know, you have a very smooth opening. Next slide. We're going to go through a few properties now that we have, which hopefully you find interesting. I think we're going to cover 4 or 5 here. And then again, if you have any specific questions about any of these, we're starting out here with Las Vegas Owens, and it just so happens that we are in Las Vegas at the moment because we have a groundbreaking ceremony on this property tomorrow morning at 9 a.m. And this is the culmination of a couple years of efforts to get our building permits in place and work through the entire process. And I might add, part of that process is making sure that we do so. We deliver a beautiful project, which you can see from the renderings here, will be the best self-storage project in the market here in the 3 and 5 mile radius. And that we do it in the most cost-effective possible way. That in and of itself, we can have a presentation on that. But this is going to be about 158,000 square foot facility. As I say, we're breaking ground tomorrow. It's going to have about 1,189 units. Definitely Generation 5, excellent security system. We'll get more into what the consumers are looking for in these facilities. But as I say, will definitely be the nicest facility in the market. And here's the other thing too. I talked about institutional investors in terms of owning public storage and extra space stock. But institutional investors also acquire self-storage on their own. Okay. So when the time comes to sell this property, if we have a best-in-class asset, the goal is to sell it for the very highest possible price. And that's part of the reason that I created Your Space America, is because I didn't want to leave anything on the table anymore. I wanted to maximize the disposition prices for investors. And even though we had great returns, I thought they could have been even better, and they will be. So for example, this project costs around 23 million. We hope to sell it for in the 50s. Okay. Anyway, next slide. A little more information. Obviously, it alludes at the final sentence in here, alludes to our groundbreaking, which is taking place tomorrow. Next slide. This is another rendering of the Owens property. And as you can see, it's branded as a public storage. Next slide. This next slide gets into the overall project size, project cost, net rentable square feet, and talks about the schedule. Essentially, we have building permits in July, construction start in July, construction end of about 12 months, stabilization about December of 28, although off the record, Public Storage is telling us they think they can get this property stabilized in about 12 months. But we're not using that, and that we're assuming the longer lease up period. But as I'll get into in a minute, we choose very carefully in terms of the sites that we build, and we want projects that will outpace the market in terms of lease up and stabilization. Next slide. This next slide, once again, it covers the size of the project, 1,189 units. Groundbreaking, 4-story project, sponsor information, the concept, state-of-the-art Generation 5. And what that means essentially is this facility is obviously something that doesn't even look like self-storage. It looks more like a retail or office property. And what consumers want, about 2/3 of the people that decide to store things are women. And what they want is a safe facility, a clean facility, a well-lit facility, something where they can go to anytime and feel safe. And that's certainly what we offer. It's fully climate controlled. So right now in Las Vegas, it's about 120 degrees during the day, last few days. But inside this facility, it's going to be about 75 degrees. So you can go into this facility and you can keep your most valuable items and know that they're safe. And if you're visiting the facility, you know that it's safe. And after hours, we have an extensive security system. So you can also know that all of your belongings are safe. Down below, it talks about the economics on this deal. We designed this project to be pro-investor. And if you look at the pref and the waterfall, it certainly is. This is looked at as a 10-year hold because it's an opportunity zone investment. We do plan after about 2 years to refinance and return capital to investors. So these returns assume that you have gotten your money back around month 24, okay? But the returns just make it look like you have your money in, you never took it out. So it'll be 24.77% over 10 years projected on whatever amount was invested. So with a 4.21 hold. So multiple. Next slide. This again gets into the multiple and the cost. Next slide. Supply, existing supply. This is something that we look at carefully on every project we do. What we don't want is to be in any markets that are oversupplied. And we're diligent about making sure that we are out of oversupplied markets and that we are in markets where there's demand for self-storage. And it just so happens that there are no facilities in a 1-mile radius. There are 3 in a 2-mile radius, let's say 14 in a 3-mile radius. It's still a very undersupplied market. So this was something that we liked. And if we look at the supply in going out in the 2-mile radius, the existing self-storage supply is basically old, non-climate controlled properties. Okay. And we're going to have a state-of-the-art facility. So This is an area where the 5-mile population is 542,000 people, okay? This property is located on Interstate 15, which we'll show in just a moment, but the city is also allowing us to have an 80-foot sign. The site's about 30 feet above the interstate. So imagine you put an 80-foot sign on a site that's 30 feet above the interstate, okay? At the top of the sign is 110 feet above the interstate. This will probably be the most recognizable self-storage facility in Las Vegas. So just imagine the 177,000 vehicles per day on Interstate 15. They won't be able to miss the sign. So think of that market though, 542,000 people on it. Everybody in that market is probably going to be familiar with this property. Next slide. Talking about supply and location for a moment. The U-Haul property that we allude to as a future competition has been redone and is finished. But the Charleston self-storage property, we just found out the city has rejected their product. So that's probably not going to be built. So it's even less competition than we thought. But if you see the red dot here with the 120 West Owens address, you can see it's right on Interstate 15. I'll show you that in a moment. Next slide. You can see on this slide the location of the Interstate Highway, Owens Avenue, the property. The red dot is the property. You can see right next to it is Interstate 15 with 175,000 vehicles per day. Owens with about 15,000 vehicles per day. As I said, when we say it's on the interstate, it's definitely right on the interstate, right along the interstate. Next slide. This is the project site plan. Tried to design it to maximize the square footage with the lot, while at the same time making it a pleasant experience for our customers. So you can see there's a lot of loading areas in here, in the front, side, the back. And it's going to be shaded as well. So when people are loading and unloading and it's 120 degrees outside, they'll get some relief. It'll be easy to load and unload their belongings. Next slide. This next slide is a project that we're doing in Phoenix, which will probably break ground next month. This is another story similar to Las Vegas in the sense that it's a pretty good sized facility, going to be about 168,000 square feet, about 125,000 net rentable with about 1,225 units. This property is located about 650 feet from Diamondback Stadium in downtown Phoenix. It's about 300 feet from 7th Street, which is a major ingress and egress arterial in and out of downtown Phoenix. So when it's built and it's 50 feet high with the signage here, this is another one that nobody's going to be able to miss. You know, you've got Diamondback Stadium, which if you watch the World Series, that was the stadium, obviously, for Diamondbacks. This is another facility that's also in a market that's undersupplied, that has a lot of growth. The immediate competition in the 3-mile radius is there's really only one property that's a high quality facility, and that's another public storage property. But most of the existing competition is what I call junk, just, you know, old, non-climate. And as you know, the temperatures in Phoenix are similar to the temperatures in Las Vegas when it's hot. So this will be a facility where we have excellent population in the 1, 3, and 5-mile radius. We got here, we're going to have 362,000 people in a 5-mile radius, but there are also 17,000 residential units in a 5-mile radius that are in planning or development, which should equate to another 50,000 people over the next 2 or 3 years. So an area of strong growth, an area that's undersupplied. So we will again have, you know, one of the top facilities in the entire market here. And downtown Phoenix, Arizona is literally in and of itself a story in terms of a turnaround. 10 or 12 years ago, the downtown area was down, but is now probably the nicest part of Phoenix in terms of development and change, positive change. Next slide. Another rendering of the property, and if you look at it, it looks more like it could be an office building or retail. And again, it's branded as a public storage. Public storage is very excited about managing this property. Next slide. This again goes into the project, the size of the project, the number of units, the sponsorship. What we're trying to build here is again going to be just like Owens, a Generation 5 facility with excellent security, all of the same things that appeal to consumers who want a safe place to store. And I would also add that in terms of self-storage, we see increasingly businesses using self-storage. So we assume that about 30% now of our tenants are going to be businesses. And very often businesses use self-storage to maintain their electronic records or to keep their inventory. And it's a place where if they rent one size unit and they need more space for more inventory or something like that, they can simply expand the amount of storage that they rent at a facility. So it works well for businesses as well. Next slide. An overview of project cost, debt, equity, multiple returns. Similar, this is an opportunity zone, 24.66 IRR over 10 years with a 402 multiple. And again, we're looking to return capital around month 24. Next slide. This is a map here with a photo. You can see Diamondback Stadium in the background. Here you can see the location in downtown, but literally walking distance, obviously, to Chase Field, Diamondback Stadium. Next slide. This next slide is essentially an overview of the population. The MSA is about 5 million, GDP 261 billion. But it shows also the growth of the MSA from 1980. Phoenix is quite a success story. And it has, as you can see, there more than 3 times the population it had in 1980. Not many places can say that. Next slide. This next slide is the site plan. It's obviously a rectangular shaped parcel. But I think it fits well on the property. We designed it so there's plenty of loading, unloading area in the front. So it's easily accessible for tenants. Being that it's rectangular, if you have plenty of loading in front, you don't need it really on the sides and back. So next slide. This next project is one that we're doing in Tucson, also an opportunity zone. As you can see, it's branded as a public storage. This property, interestingly, is located on a freeway on-ramp. I tell people this is my first project on a freeway on-ramp. It's on the freeway on-ramp to the interstate highway. Across the freeway, there's about 1 million square feet of power retail. And this building is going to be about 40 feet when it's completed. So imagine you have a building 40 feet high. It's right along the interstate highway. And right across the highway is all this retail where thousands of people are shopping. Everybody in that area is going to see this property. This, again, like the other two, will be, among the most recognizable self-storage facilities in the market. And the nicest. Next slide. Another view. This is what it'll look like from the interstate. Okay. Very, very nice, right? Next slide. Another rendering of the property. Next slide. So this essentially is going to be nearly 1,000 units, about 129,838 square feet, 3 stories, opportunity zone project. And again, like the other properties, essentially the same business plan to introduce a Generation 5 modern climate control facility to the market with full security, a safe environment for consumers, but the same story basically. Market leading property. Next slide. A little more information on the property. 3 and 5 mile populations are strong, lower than Houston, lower than Phoenix and Las Vegas, but still strong and still an undersupplied self-storage market. But the location of this property, though, in Tucson, being right on the interstate highway again, will give it a lot of advantages in the marketplace, competitive advantages in the marketplace. Next slide. This slide shows you the interstate, the project, and the proximity to the interstate. Down below shows you the per capita supply, which is the amount of other self-storage in the market. And as you can see, going all the way out to a 7-mile radius, you've got an undersupplied market. So you will be in an undersupplied market with the best facility in the market, the most recognizable facility in the market, which is, you know, what you dream of as a self-storage developer. It took about 2 years to get this project approved. We put it under contract and spent 2 years changing the zoning. We expect later this year to break ground, but nearly a 3-year process from the time you find the site to the time you break ground. In this case, often it's 1.5 years, 2 years, or 2.5 years. It's not a quick process, but that's also how you create a lot of value. Okay, like for example, this project, the site appraised for 3 times what we were paying for it. So we like to do deals where, let's say we're paying $2 million for a site or $3 million for a site. We like to do deals where we know when we get it approved, it's probably going to be worth at least a couple of times that or more, just when we break ground. So we create immediate value in terms of the site and what we've done at the site. Next slide. Again, some more maps that show you the area, but you can see in the lower right-hand corner, you've got all this retail across the street on both sides, loaded with retail. You know, everything from Home Depot to Best, you name it, across the freeway, the really high quality retail. And here's our property. Next slide. This next project is one we're doing in Las Vegas. It's called Mount Hood. This is about 15 acres. And this is a project that will be, when it's completed, the nicest RV and boat parking facility in Las Vegas and combination self-storage property in Las Vegas. There's huge demand in Las Vegas for RV and boat parking. And what we're trying to do here is take the RV and boat parking to another level in terms of quality, because there's a market for it and people will pay for it. So we have a large number, about 180 garages that we're going to have that are going to be 15 feet wide, 15 feet high, and either 45 or 60 feet long. So, you know, if you have a motorhome that you spend $500,000 for and you need a safe place to store it, you can bring it here, electronic doors on the garages for everybody. Park your motorhome and know that it's safe. We're also going to have covered RV and boat parking here as well. But as I say, when this is completed, we expect it to be the nicest of its type in Las Vegas. This is a project that's also contiguous to Nellis Air Force Base, and Nellis was involved in approving the project. And initially there was going to be 5 acres of multifamily, 10 acres of storage. They wanted the whole 15 acres to be self-storage, and the county commissioners agreed. So it was approved unanimously by the county commissioners. They fully supported the project, and it's something that's needed in Las Vegas. But as I say, when it's done, it'll be the nicest of its type in Las Vegas. And in terms of 15-acre parcels where you can do RV, boat, and self-storage, I'm not aware of any other sites like this in Las Vegas. So I don't expect having a lot of competition in the future from similar facilities either. Next slide. The other thing I was going to note too is in this area, this is another area where there's a lot of development going on. In fact, within walking distance of this property, they just finished 1,500 new homes. Okay. So a lot of growth going on in this area, and certainly not only do they need RV and boat parking, but they need self-storage. And there's not much quality self-storage in this market either. This is another story of what I mentioned earlier, what I call junk competition and junk for the most part. And again, we will have the nicest facility in the market. Next slide. This next slide is an overview of the costs. It's about a $47 million project. We expect to have our building permits in the 4th quarter, take about a year to build, with stabilization in 2028. Next slide. This is projected to be a 4 to 5 year hold. As you can see, the project costs, IRR multiple. It's a shorter hold because it's not an opportunity zone project, but it's a very compelling, I believe, in terms of the overall rents. And I think we've underwritten this conservatively. My belief is, and I'm hopeful, that we can achieve rents on the RV spaces higher than what we're predicting. Okay. Which would be exciting. So this is a project that we're saying is 47 million. The goal here is eventually to sell it for about 125 million. Okay. Next slide. This next slide is kind of a layout, as you can see, of the RV and boat parking area, and you can see the self-storage facility over to the right, a rendering. Next slide. If you look at the next slide, it gives you an overview. You see the self-storage facility in the front, and then along the back, you can see all the garage RV boat units. You notice that they're at an angle. We did that on purpose so that it's easier for people to pull in and out, because if it's just straight in, it's more difficult than having it at an angle. In terms of circulation as well, you can drive in, back out, it's easier. We're also going to have drive-up units at this facility as well. And as you can see from one row in from the back, you have the covered RV and boat. So at this facility, I think we've got something for everybody. You've got self-storage, you've got drive-up units, you've got covered RV and boat, you've got a garage RV and boat. The other thing about RV and boat parking is the tenants generally tend to come from a wider geographic area. So we assume that most of our self-storage tenants come from the 5-mile radius, but in terms of RV and boat parking, that comes generally from a much wider, people could be 10, 15 miles away. This property also is 1 mile off of Lake Mead Boulevard on the way to Lake Mead, which is the 3rd busiest recreation area in the United States. So we believe that the people that use Lake Mead will also be customers here at this facility. Next slide. This next slide is kind of an overview of what I mentioned: 1,193 climate control units, 271 drive-up units, 133 enclosed garages, 86 covered units. An overview of the facility. Next slide. This next and last project we're going to talk about today is in Houston, Texas. This is a rendering of the facility. Very, again, attractive, branded as public storage. Next slide. Another rendering of the project. Next slide. Another rendering. Next slide. This project, a little over 3 acres, is going to have some RV and boat parking as well. It's also going to be self-storage. And again, a Generation 5 facility, climate control. The interesting thing about this area, this is a property, once again, is near the interstate highway. It's about 1,000 feet from the interstate highway, so it'll be very visible when it's finished. But this just happens to be in a market that's undersupplied as well. And in the 3-mile radius, there is no climate controlled self-storage. And of course, Houston, obviously, certain times of the year has a very warm climate or very cold climate. So there's definitely a need for climate controlled storage. Out to the 5-mile radius, there's climate controlled storage, and they get very strong rates for that, up to $2.35 a foot. So again, we're going to offer climate control storage in a 3-mile radius that doesn't have any climate control storage. So that's one of the compelling things about this project, and also RV and boat. But it's kind of a niche, if you will, and since we found a site where there's not a lot of competition, there's not a lot of climate control, yet it's in a market. Houston is a very fast growing market, so another growing market that needs self-storage. So we think this project is going to be very successful. Next slide. Some highlights, the property and the project, 1,094 units. Late Q3, it might even be Q4 groundbreaking. 147,000 square foot facility. Climate control, state-of-the-art Generation 5. Next slide. A little more information on Houston, the 4th most populous city in the nation now, an area that's fast growing. People are talking about Houston eventually becoming the number 3 city in the U.S. So again, what do we have here? We have a market where we are in an undersupplied market in a growing area, in a good location, highly visible. We're filling a need. There's a demand, obviously, for this product. And this will be, again, the nicest facility in the market. Next slide. This next slide shows the growth in the population between now and 2027. Again, significant growth. And the growth since 2010, very impressive. Next slide. This next slide is essentially an overview of what I mentioned about the supply. As you can see, square feet per capita is 2.52 in the 3-mile and 3.65 in the 5-mile. And equilibrium in terms of self-storage is around 8 square feet per capita. So significantly undersupplied. And then if you look down, you can see the rates that they're getting on climate control units in the 5-mile. Here, its average is $2.45. So again, undersupplied, excellent rates, quality facility. Next slide. This next slide essentially shows you the competition in the market, the proximity to the interstate highway, 3-mile radius. Next slide. This next slide shows you the 5-mile radius, again, the competition, and then square feet. After all projects that are in the pipeline are built, still significantly undersupplied. Next slide. So you can see down in the lower right-hand corner, lower left-hand corner, and in the top photo, you can see the interstate highway and the proximity of our property to the interstate highway. Pretty easy ingress and egress access to the site. Okay. Next slide. This next slide is the site plan. You can see the project itself, 3-story self-storage, and then you can see the RV and boat parking in here. This is going to be covered RV and boat parking. Next slide. This is another project that's going to be a 4 to 5 year hold. You can see the total project cost, equity, debt, projected IRR, multiple 5.03, 5-year hold. Very compelling returns on this project. Next slide. So that is it for the presentation. And I guess now we can go to anybody that has any questions regarding anything we've just discussed.
We do have some questions. Brian asks, generally believing no free lunch and markets over time are efficient, why has commercial real estate capital market prices storage? Why do they price storage so inefficiently, i.e., so far off the risk versus reward efficient frontier for so long?
I'm not sure I quite understand exactly what you're talking about, but I'll give you some examples. In many of these projects, we're assuming we're going to sell at a 4 cap, and then we have some people that say to us, well, that's kind of a low cap rate compared to other product types. I said, yeah, but that's the kind of prices you can get in a hot market for self-storage. In fact, in 2021, I sold 2 projects at below a 4 cap rate, at about a 3.5 cap rate. And that is basically the goal for any of these is, as I mentioned early on, to maximize returns to investors, by choosing the ideal time to sell, not selling too early. Because very often investors can say, oh, wow, we've owned this thing for 3 years. If we sell it right now, boy, we can make a 32 IRR. And my argument has been in some cases, well, yeah, that's great. But if we own it for another year, year and a half, we can make even more. Okay. For example, I have another project in Las Vegas that was recently completed. And we were offered to sell the property at completion for about $9 million more than the cost. And my advice to my partners was not to accept the offer, because that would have been a sales price of about 25 million. My advice was that we could keep it, 12 to 24 months beyond completion and probably sell it for 35 million. So why give it away for 25 million? But some people might argue that, oh, we're selling it for 25 million and we made a $9 million profit and we've been involved in it for 2 years and we invested 5 million in equity. That's a great return, and it is. But again, I'd like to wait another year or two and make another $10 million. Okay. So then the profit is like $19 million instead of 9. So choosing the ideal time to sell is important, not selling too soon. I might be dating myself here a bit, but some of you may remember the old Gallo wine commercial, we will sell no wine before it's time. I tell people this all the time about self-storage. We'll sell no property before it's time. So again, just looking to maximize returns for investors, and in terms of cap rates, generally will be lower than just about every other product type because of the safety and the returns. Anyway.
Thanks, Russ. I appreciate that. I hope that answered the question, Brian. If it didn't, tap something out in the chat box and we'll get back to it. In terms of, while we're on the subject of timing, take us through the timeline. I know it's going to be different because each locale has different, regulatory and different permitting processes and things. But from, you're breaking ground in Las Vegas. Let's start with that one. You're going to break ground today in Las Vegas. You're going to build that out. Then you're going to begin to market. You can begin to get occupants in there. What does it take in terms of time to get up to what would be considered full occupancy, and what is that? In other words, are you meeting,
we're
meeting the revenue
conservative.
metrics to pay,
Yeah.
meeting the revenue metrics that you guys have targeted?
If you look at our financial models, they're pretty conservative. We tend to be a little higher on expenses, which is conservative. And even with Public Storage, they've modeled some, and their expenses were lower than ours. Essentially, we assume about 30 to 36 months for full stabilization, but given the locations of these properties, it shouldn't take that long. It should be more like 12 to 18 months. But I'm much more enthusiastic about telling people it's going to take, 24 to 36 months for full stabilization and have it done in 18. Okay. That way, we're not disappointing anybody. We're outperforming. But this other one in Las Vegas has been open for, excuse me, about a month. It's already 10% occupied. I feel that one probably be leased up in a year. But then after you get it leased up, Public Storage will tell you that they like to drive occupancy and then they like to drive rates. So stick with me on this for a minute. So let's say we fill it up in 15 months. Okay, we get to 92% occupancy. So what are we going to do for the next 12 months after that? Well, what we're going to do is we're going to obviously look to hold that type of occupancy, but we're also going to look to drive rents. Okay. So, if our average rent is $1.60 at the end of the first 15 months, we're going to be trying to push it to $1.80, $1.85, or maybe a little more for the next year. Okay. And slowly, increasing it more. So when we get to the time of disposition, we've driven rents, and income as far as possible. Does that answer that?
I think it does. And again, we encourage anyone to jump in and ask a follow-on question, which anyone who's really starting their due diligence process on this should do. You guys have chosen a greenfield construction model versus the acquisition of the mom and pops that were very typical years ago. Is that driven primarily by the locales you're dealing with are very weather challenged, so to speak, very hot, humid in Houston's case, and you're looking around and seeing a dearth of climate control? Is that your reason for selecting this? And is it, do any of the locations that exist within the area, the competing locations, did they ever make sense to acquire those and knock them down or rehab them?
Stick with me on this one.
Okay.
That's actually part of our business plan, in which something we will be focusing on more and more is acquiring existing properties and creating value. In fact, I've even done presentations on this. I did that when I was CEO at Core. We bought 7,000 apartment units, improving them with the idea of, driving value, or 4 million square feet of industrial that I purchased. But what we're looking to do here is not just develop things from the ground up, but also to buy existing projects in good areas and do things that improve the condition of the property. Maybe it's a B- or a C property, and you can acquire it and renovate the property and maybe even add some climate control if there isn't any. But improve the overall condition of the property. And what you do there is you obviously improve the condition, you drive the rents, but you also change the market perception regarding the property. So the market that may have perceived it as a B- or C property will now look at it as an A or A- property. So when you go to sell it, you will get a lower cap rate and you will have driven the rents by improving the property. So you basically make money two ways. You make money by the fact that you improve the property and drove the rents, okay, and increase the value. but you also will increase the value because you will appeal to a different market that's looking for a, A minus property, and will fetch, a lower cap rate. So you make money two ways. But we definitely plan to be doing, value add acquisitions as well. And there are certainly opportunities. I think the thing has been holding us back has been interest rates. And you can justify these rates on a more temporary basis for construction projects, but it's hard to go out and buy an existing property and say, well, I'm going to be paying, 7% for the mortgage and make it work. But if I'm going out and I'm paying 5.5%, it's a lot more doable deal economically.
Okay, good.
And by the way, we're looking, obviously, everybody on this call is probably is more aware than I am, that we're looking to go into an environment here in the coming months of lower interest rates after coming from a higher interest rate environment. So a year from now, we should be in a lower interest rate environment, which should also put us in a lower cap rate environment, which should also drive housing, which should also drive self-storage rents. Does that make sense?
Yeah, from your lips to God's ears. Let's hope that's the case. I'd like 25 to be.
That's the consensus generally in the industry.
25 I'd like to see.
Yeah.
Yeah. While we're on that, you talked about, you hinted at the kind of criteria you look at in terms of coverage per capita of units. You look at the quality of competing properties, the distance, the location to major arteries, and all that kind of stuff. Are there any other factors that guide your decision on go, no go, or it's underserved or overserved?
Yeah. So I have done a few projects where there was currently equilibrium or may have been slightly overstored. Okay. But all of the competition was essentially junk. So the argument being that we would make a qualitative addition to the market in a good market, which meaning that our property would bring a lot of customers just by virtue of its quality and the fact that it was climate and all the rest of it. Essentially that we'd knock out a lot of the competitors, if you will, when people are making a choice to where to store. If we're perceived as having, the nicest property in the market and climate control and all of those things, there is the qualitative addition argument, if you will, bringing a property in as a qualitative addition to the market.
Okay.
Whereas all these others we talked about today are all qualitative additions in a different way.
Okay. Let's get to a couple investor participation questions. Are these standalone? What's the structure of investor participation? Is it a fund? Are these standalone projects? What are the minimums?
These are all standalone. And in terms of investment sizes, we have people that invest $1 million. We have people that invest 25,000. We don't generally turn anybody down. We generally say our minimum is 100. But we have had a few people that wanted to put in 25. They're welcome.
Accredited and non-accredited?
Yeah.
Okay. Accredited's only?
Yeah.
Okay. All right. And then you talked about return of capital within 24 months, but this is a 10-year. In the case of one of the projects, it was a 10-year.
On the Opportunity Zone project.
In the Opportunity Zone project. So, okay. All right. So the idea is return of capital and then income.
Well, and let me just touch on that for a second. So on the Opportunity Zone projects, probably one of the best real estate programs that's ever been developed in terms of somebody can own it for 10 years if they're doing a qualified op zone deal, put the money in, their gains are not taxable. All of the depreciation that they claim, there isn't any recapture. It has huge tax benefits, but we feel that we have a responsibility to do the required hold period so that our investors can achieve their tax goals of not paying any taxes on the gain. And also, by the way, if we build a state-of-the-art facility today, okay, 10 years from now, it's still going to be a state-of-the-art facility. You know, if it's a market-leading facility today, 10 years from now, we build a great facility, we take good care of it, it's still going to be, you know, market-leading facility. Okay. So again, you know, we'll be looking to fetch in 10 years, you know, the highest possible prices. I mean, we're thinking on Owens and Phoenix that those disposition prices will be in the 50, early $60 million range in 10 years.
Okay.
Okay, not bad for properties that where the cost is in the 20s.
Very good. Yeah. Yeah. It'd be very good. I think we've got all our questions answered for now. The contact information, I believe, is still on the screen. If it isn't, we can find a way to put it back up there, but I believe I'm still sharing that. So
let me add something on the contact.
okay.
I like to be available to my partners. So contact information is there. You know, we have a great team here, but if you want to contact me directly, my phone number and my email are there. Please feel free to do so whenever it's convenient. You know, if it's 7 o'clock Friday night or, you know, 11 o'clock Saturday morning, whatever, just call me or email me. Okay.
That's fine. That's great accessibility. Well, listen, we'd like to thank both of you, Russ and Billy, for coming in and getting us up to speed on this and showing us how you guys do things. You know,
thank you.
Presentation, really enjoyed it. Again, we urge those of you who are interested to go ahead and get in touch. You've got the contact information. All of you will receive a copy of this presentation and receive a link so you can watch it again. And anyway, we hope this has been enjoyable, and thanks for sitting in and giving us your lunch break today. And we look forward to seeing you next week.
Yes,
Great.
thank you everybody for taking your time today. Appreciate it.
Yeah, thank you very much. You
Take
know,
care now.
Charlie,
All right.
really appreciate
Bye-bye.
it.
You're welcome.
Thanks.
Bye-bye.
Okay, take care.